This is the Chapter 9 in-class problem. On January 8th, the end of the first weekly pay period of the year, our employees earned $22,760 of office salaries and $65,840 of sales salaries. Withholding is Social Security at 6.2, Medicare at 145, federal income tax, medical insurance, and union dues. No employee earned more than $7,000 in this first period. So what they're asking us to do is calculate the Social Security and Medicare for the employees, and then record the full journal entry, and then in 2, the employer, and record the journal entry. And it even tells us the state rate is 5.4% and the federal rate is 0.6%. So I'm going to do one here. This is the employees, and I'm going to do 2 over here, and this is the employer. There we go. So I'm going to separate it like that. I should be able to squeeze all of this onto this screen. So first, we're going to record the gross pay. We're going to record the total amount of expense that we are paying our employees. So they broke it up into 2 pieces in this problem. They've got office salary and sales salary. Sometimes the problem will just have salary expense or salary and wage expense, something like that. Both of these are expense accounts. We're increasing them, so we're going to debit them. Next, we want to record the net pay that we're going to pay out. So if we were paying out cash at the same time we're recording all of this stuff, then I'm going to leave lots of space to work. I'll put it way down here. Then I would record a debit to cash. So this full amount over here, our credits, let's see, 22,760 and 65,840. And so the sum of that is 22,760 plus 65,840, 88,600. So if there were no deductions and I was paying cash on payday and recording this expense on payday, then this is what my journal entry would look like, and I'd be done. This is not the typical way of doing it. The typical way of doing it, and I don't think this problem's specified. So I guess technically if you wrote the credit to cash, you'd be okay. But the typical way to do this would be not cash, but salary expense. I mean, not salary expense, sorry, salaries payable. Salaries payable. There we go. A liability account that we're increasing with the credit. So that's the way, that's the typical way that we record this. So that should be your go-to default way of recording this, unless somehow the problem told you we pay cash on payday or something like that. We pay cash when we're recording the expense. But this problem didn't say anything, so we're going to put it to the liability account called salaries payable. And we know there are going to be deductions. So this is actually going to be our plug. Whatever's left over is going to go to that salaries payable account. So let's calculate all of the other payables that are the deductions from gross pay. We'll start off with Social Security. So I'm going to abbreviate a little bit. This is going to be a credit. I'm going to go social. Let me change the color back to blue. I'm going to call this Social Security payable. And we need to calculate Social Security payable. So we've got, what was it, 88,600? Oh, I think I still have it here. 88,600 is our total salary, and this is our very first pay period of the year. So we know we haven't gone over the max of 132 something or other. And really we know because there are multiple employees here. And the only way we could be close is if there was a single employee that we paid the full 88,600 to, and even then we wouldn't be close to the threshold yet. So the threshold doesn't apply here. All of the salary is going to be subject to 6.2% times 0.062 for Social Security, $54.93.20. Yes, let me put some cents on the end of there. And Medicare is 88,600 times 0.0145, $12.84.70. So those are the two we have to calculate. You have to know how to be able to calculate the Social Security and the Medicare. The rest of these on the employee side, they're going to be given to us. So we've got federal income tax. We're going to just call this, what is it? The problem call it employee. Federal income tax payable of $12,860. And so I got that, and I got that, and I got that, and I got that, and I got that. Let me make sure I'm not missing anything. And then we've got, I guess we'll stick with this same format, employee insurance payable of $13.40. And employee union dues payable of $840. And then I'll move this salaries payable up. And that's going to be the difference. So I'm going to start off with my 88,600. Actually, I'll just go 22,760 just to double check my math, and 65,840. Yeah, 88,600 minus all of these deductions, minus 54.93 minus 12.84 minus 12.860 minus 13.40 and minus 8.40. So that leaves me 66,782.10. 66,782.10. That's my salaries payable. And it didn't ask me this, but sometime later we will get rid of that salaries payable. By paying our employees. So credit cash for that same amount. That's not part of the problem, but at some point we're going to have to pay our employees the salaries payable, and that's what the journal entry would look like. Okay, let's move over to required to. And here they're asking for the employer piece. So our debit is going to be payroll tax expense. It's an expense account. We're increasing it. We do that with a debit. And this time, that's going to be our plug number. We're going to calculate all of the amounts that the company owes for payroll, and then add them all together, and that's what's going to be the expense part. So now let's handle the pieces for what the employer has to pay in taxes. When you get a problem like this that's asking for both the employee piece and then the employer piece, it's kind of nice because there's only 4 pieces that we have to handle on the employer side. And 2 of them are Social Security and Medicare. And they're the same as what we just calculated. So we can just, matter of fact, I'm going to cheat. We can just see if that works. Use that exact same Social Security payable, Medicare payable. We're even using the same accounts. We're going to put the employee portion in that account. Now we're going to put the employer portion in that account. And when it's time to send it off to the government, we're going to take everything that's in there, the piece that we got for the employee and the piece that we put in from the employer. We're going to send that all off to the federal government. So half of this journal entry is, or at least the credit side of it, is done already. The rest is the SUTA and FUTA. So we'll go SUTA payable and FUTA payable. And this is the percents given in the problem. Typically, we're going to see the 5.4 for the state and the 0.6% for the federal. So our payroll is $88,600. We have to be careful here because remember, $7,000 is the limit. So we only pay on the first $7,000. And when our payroll is $88,600, if that all went to one person, then we're only going to use $7,000. But that's not the case. We have multiple employees. We don't know how many. It's not told in the problem. But we are told in the problem that in this first pay period, nobody has gone over $7,000 for the year. So because of that, all of the salary is subject to FUTA and SUTA. So let's calculate that. It's 88,600 times 0.054, $478.44. I must have done something wrong there. Let me try again. Oh, that's what I did wrong. 88,600. That's our salary. Times 0.054 is 5.4%. There we go. Looking for that slightly bigger number. 4784.40. That's SUTA and FUTA is the same 88,600 times 0.6%. So converting that to a decimal is 0.006. $531.60. And now to get the expense amount, we have to add those 4 pieces up. So the 531.60, make it a little smaller there. The 531.60 and 4784.40 and 1284.70 and 5493.20. $12,093.90 is our debit. Yep. Okay, there we go. So that is part one. Here is part two. This is a warranty problem. On October 29th, we began operations, so this is our very first, month? Began operations by purchasing razors for resale. We put a 90-day warranty on these razors for our customers. When there's a bad razor and the customer brings it back, we simply throw it away, grab a new razor out of inventory, and give it to the customer. So we don't try to repair razors or anything like that. We pay $20 per razor, and we sell them for $75 per razor. We expect our warranty cost to be 8% of our razor sales. And then we've got all these transactions. I spread them out because I'm going to try and write the journal entries by all of the transactions. So we've got all of these transactions in November, December, and January. And we are told to write the journal entries. And then we're asked, how much is the warranty expense in November and December? And then we're asked, how much is the warranty expense in January? And then what is the ending balance for the estimated warranty liability account at the end of December and at the end of January? Okay, so first, journal entries. You guys love journal entries yet? First, journal entries. On November 11th, we sold 105 razors for $78.75 cash. They didn't have to tell us that. 105 times, it tells us that we're selling them for $75 each. So $78.75, be prepared to calculate that one yourself. For $78.75 cash. Okay, so we need to record the sale and we need to record the cost journal entry as well. So we've got two, the revenue journal entry and the cost journal entry. First, let's record the sale. They gave us cash. So we're going to debit cash and we're going to credit sales. I don't know, is this the only thing we sell? I guess this is the only thing we sell. I guess we could be specific and call it razor sales. But if this is the only thing we sell, sales probably works too. And you know what? I am going to leave it as sales because I haven't given myself much room to work here. And so the smaller the better. Oops. And none of that is working. So we'll do it the old-fashioned way with an eraser and a rewrite. So cash is an asset account, we're increasing it, that's why it's a debit. Sales is a revenue account, we're increasing it, that's why it's a credit. And the amount was $78.75. Now we need the cost piece. So we are going to debit the expense account called cost of goods sold, and we're going to credit the asset account called merchandise inventory. For the cost is not told to us. We do have to calculate that. 105 razors at $20 each, so $2,100. This is moving the cost of the 105 razors out of the inventory account with a credit and over to the expense account called cost of goods sold with a debit. Next, recognized warranty expense related to November sales with an adjusting journal entry. So at the end of, we're doing this monthly, at the end of each month, we're going to record the adjusting journal entry for the warranty, the estimated warranty expense, which is 8% of our month's razor sales. So we sold $78.75 of razors, and 8% of that is $630. So what we're going to do here is we're going to expense $630. So let me put that right here. We'll call it warranty expense for $630, and we're going to set up a liability account to put this $630 in, because we haven't gotten any returns yet. We're expensing ahead of time. We're pretty sure we're going to get returns. We're pretty sure that some razors are going to be bad. So we're preparing for that right now. We're estimating an expense to record in November so it can be matched up with November razor sales, even though we haven't gotten any bad razors yet. So our credit is going to be to this liability account called I don't know if that's bad handwriting or bad spelling, but I'll start again. Now that's bad handwriting. Estimated warranty liability. It's a liability account. I'm going to make a little bit more room here. It's a liability account that we're increasing with a credit. So our debit is to the expense account, and our credit is to this liability account that we're starting up right now called estimated warranty liability. It's just a place to hold this $630 that we have pre-expensed in anticipation of some of the razors, some of the November sales, some of the razors we sold in November turning out to be bad. Okay, so there's November's, and then we're just going to do the same thing in December and January. The only difference is we're going to start getting returns in December and January. So, here we go, December 9th. Replaced 15 razors that were returned under the warranty. So we had 15 different customers bring back 15 different razors. We took them, said, we're very sorry. We threw them in the garbage. We went and got them a brand new razor, gave them the brand new razor, said, we hope this makes everything right. We're sorry it happens from time to time, but we stand by our razors. So now we're going to record that. We have to pull those razors out of inventory. So that is going to be a credit. I'm going to write it down here and over to the side. It's going to be a credit to merchandise inventory of, there we go, what was it? 15 razors that cost us $20 each. So $300. That merchandise inventory is an asset account that we're decreasing. That's why it's a credit. And what we're used to seeing when we pull stuff out of our inventory account is a debit to an expense, and it's almost always the expense called cost of goods sold. We are not going to debit the expense this time because we already did that back on November 30th. We have already hit the warranty expense account. So now we're going to use up some of that estimated warranty liability on December 9th. So that's what this looks like. Estimated, I'm going to abbreviate a little bit, warranty liability. for $300. That's the liability account that we're using some of it up. We put $630 in there at the end of November, and we've just used up $300 of it right now at the beginning of December. So a debit to estimated warranty liability and a credit to merchandise inventory, because we're just going and getting these 15 razors out of inventory, so we need to reduce the inventory account. We're just grabbing them out of inventory and giving them to the customer with our apologies. Okay, the rest of it is more of the same. So December 16th, we sold razors. So we've got 2 journal entries to write. First, I'm going to debit cash for $16,500. And they told us the number, but we should be able to calculate 220 razors. We sell them for $75 each. That's the $16,500. And then we record the sales for the same $16,500. Now we need to record the cost. And that is going to be a debit to cost of goods sold and a credit to merchandise inventory for the cost amount. So the same 220 razors, but they cost us $20 each. So $4,400. $4,400 is what we're pulling out of merchandise inventory and expensing to cost of goods sold. Next, on December 30th, we got some more bad razors, this time 30 of them that were returned under warranty. So again, we're not going to expense. We've already expensed and created that estimated warranty liability account, so we're going to hit that estimated warranty liability account. We're going to debit it. It's a liability account. That's how we reduce a liability account. So this is estimated warranty liability for, oh, I got to multiply, 30 razors at $20 each, $600. So for $600, and then we're pulling them out of the merchandise inventory account. So we're going to debit merchandise inventory for that same $600. And then on December 31st, we have another adjusting journal entry. The adjusting journal entry is to record December warranty expense. And so we find how much sales we had in December for our razors. And it's just December 16th is our only sales entry. So 16,500 times 0.08, 8%. So 1320. 1320 is our adjusting journal entry. We're writing it at the end of the month. We're doing these adjusting journal entries here in this problem at the end of every month. 1320 is what we're going to expense to warranty expense for the month of December. So that journal entry looks like this. I'm going to write it over here. It's got a little bit of white space over here. Warranty expense for, I don't remember what it was, 1320. And we're going to credit that liability account called estimated, I'm going to do a lot of abbreviating here, warranty liability for 1320. So we're putting another 1320 into that account so we can use in future months. And next, on January 5th, sold some more razors. Again, this is a debit to cash. We sold it for cash. 150 times $75 each should be $11,250. And then we record our razor sales to the revenue account called sales. Increase that with a credit for the same $11,250. That's just the first journal entry. Whenever we make a sale, we've got to record 2 of them. That's the revenue piece. We need to record the cost piece. That's a debit to cost of goods sold. for the cost of these things, 150 times $20 each, $3,000. And we're going to reduce merchandise inventory for the same $3,000. And then on January 17th, some more bad razors came in. So we're going to reduce the merchandise inventory account with a credit, and we're going to debit the estimated liability, estimated warranty liability account. We're not going to debit a credit. We're not going to debit an expense. We're not going to debit an expense. We do that. We hit warranty expense at the end of every month with that adjusting journal entry. So when it's time to actually change out the bad razors, we debit estimated warranty liability. Our little savings account. 50 at $20 each. I probably could have done that in my head. $1,000. And pull it out of merchandise inventory, because remember, when we get these bad razors, we just go grab new razors. We just went and grabbed another 50 razors out of our inventory. So merchandise inventory, we reduce that. It's an asset account. We reduce it with a credit of $1,000. And then finally, our last journal entry is the adjusting journal entry at the end of January to record January warranty expense. So we find our January sales number, and again, we just had that one sales transaction, 11,250. So 11,250 times the 8%, 0.08, $900. So now, at the end of the month is when we hit warranty expense. Now we're going to write this adjusting journal entry that debits warranty, can't spell, try again, there we go, warranty expense for the $900 I just calculated, 8% of our January razor sales, and we credit, we fill back up again our estimated warranty liability account for the same $900. So there's all of our journal entries. Now, how much warranty expense is recorded in November and December and January? Since they had us write all these journal entries out, we can just go back and look at the journal entries. So I'm just going to look for every time I wrote a journal entry that that debits warranty expense. So in November, there, and nothing else in November. So this is $630 in November. And December, we only hit it at the end of the month as an adjusting journal entry. So $1,320. And I can't remember how they want this, if they want this separately or together. So there's separately, and if they want it together, $630 in November and $1,320 in December is $1,950 total for those 2 months. And then how much in January? So again, we're just looking for warranty expense. We only hit warranty expense at the end of the month. So jump right to January 31st, and we can see it's $900 there. What's the balance of the estimated warranty liability account as of December 31st? So I'm going to do the same thing. I'm going to change my highlighter color, but I'm going to do the same thing. Since we wrote out the journal entry, I'm just going to go look for every time that we're hitting the estimated warranty liability account. I'm going to start off with 0. This is a liability account. It's going to have a beginning balance, and it's going to have additions and subtractions, and we're calculating the ending balance. So just to keep with that formula that you should be good with by now, beginning balance plus additions minus subtractions equals ending balance. I'm going to start off with a beginning balance, but this is a brand new company, so our beginning balance is 0. So from the beginning of time, which for this company is October 29th, we started off with 0 in that account. And now I'm looking for any time that I hit estimated warranty liability account. I'm going to highlight it yellow. So November 11th, nope. And November 30th, I am expecting to see it at the end of the month because that's when we fund this liability account, if that's what you want to call it. So $630 there. Now, keep in mind, credits increase this account. So credits, whenever we credit it, that's a positive number. Debits decrease this account. So whenever we debit this account, I'm going to write it as a negative number because we're trying to we're starting with the beginning balance, and we're going to add the additions, and we're going to subtract the subtractions, and that's going to get us to the ending balance. So this is a plus 630 because it's a credit. This is where we're funding the account or increasing the account at the end of every month. Keep going. Unlike the expense where we only expect to see it at the end of the month, we will also see this estimated warranty liability at the end of the month, but we're going to be hitting it throughout the month as well. And we see that right here on December 9th. We hit it for $300. So minus $300. And then we hit it again on December 29th. So now minus $600. And then we added to it at the end of December. We added $1,320. So beginning balance of 0 plus our additions minus our subtractions will give us an ending balance of 0 plus 630 minus 300 minus 600 plus 1,320. 1,050 is our ending balance as of December 31st. And now they're asking us for the ending balance as of January 31st. We're going to use the same formula, only now we do have a beginning balance. Our beginning balance for January is our ending balance from December. So we're going to start off with 1,050 in there, and then we're going to look to see what additions and subtractions happened in the month of January. So on January 5th, we didn't touch that estimated warranty liability account, but on January 17th, we debited it for $1,000. So debit is when we use some of it up. And then nothing else until the end of the month when we put some more money into it. $900. Okay, and so beginning minus 1,000 plus 900, 950 bucks. That's how much is in there at the end of January, and that's our problem.